touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's get you all the headlines at this hour. India will go to polls in 7 phases starting April 11th. Counting of votes will take place on May 23rd. The Election Commission will also hold simultaneous assembly elections in Andhra Pradesh, Arunachal Pradesh, Odisha and Sikkim. Elections to Jammu and Kashmir Assembly have been deferred. State Bank of India will link interest rates on savings deposits of over 1 lakh rupees to RBI's repo rate from the 1st of May, becoming the first domestic lender to link rates to an external benchmark. IDBI Bank is looking to sell 10,000 crores worth of stressed assets to improve its bad loan ratio. And there are a bunch of news on the power space. So we'll talk about all of those. It's a packed show. It's a packed first word. It's a packed trade setup as well. Let's take a look at the trade setup for the day. Firstly, cross-border tensions and, of course, de-escalated, but still on the fringe. At the fringe, there is a consistent bit of news flow that could keep an equity watcher or a political watcher worried. First, India stopped the water of 3 eastern rivers flowing into Pakistan. This is a statement that came from Union Minister Arjun Meghwal. He's the Union Minister of State for Water Resources. Presumably, the latest move does not violate the Indus Water Treaty, as the water has been stopped of the 3 eastern rivers that India is entitled to use under the treaty. So, no violation of treaties, but this has happened. In other news that the Quint reported and others have reported too, I'm borrowing this line from the Quint. Army shot down intruding UAV in Rajasthan, and India, of course, has said that Pakistani forces violated a ceasefire agreement along the line of control in Poonch. So those skirmishes and those stresses at the border continue. Do they have a big bearing on the market? I guess not. I mean, if we just look at what the markets have been doing, I think they've been moving up despite all of this. However, keep this at the back of your mind. Also keep at the back of your mind what the world markets did in the week last and what the US markets did on Friday. So a bit of a soft tail Friday session as well, rounding up what was arguably one of the worst weeks of 2019, and the data wasn't the most positive. 20,000 non-farm payrolls created in February. This was compared to an estimate of 180,000. So this is a big shocker to almost anybody who was watching the US jobs data coming out, because this was abysmally lower than what anybody was anticipating. Now, the question is, as a result of that, as I said, the US markets ended slightly lower. It's not dramatically lower, just slightly lower, but they had already fallen quite a bit in the first 4 days as well, and therefore this rounded up the worst week of 2019. Is this having a big bearing on the sentiment? I'm guessing so, because this was a very, very weak and wobbly week for the US markets, and maybe some part of it is showing in the way the world markets are doing this morning as well. So the share started off very, very soft. Nikkei is up about 0.25%, but Shanghai is down about 0.25%. Hang Seng about 0.16% in the green. The SGX Nifty indicating a start which will be marginally in the red. Very, very difficult to predict really what will happen on a day-to-day basis, so I won't get into that prediction game. However, there are lots of news flow to monitor. More importantly, from an India perspective, and we'll talk about that on the show as well. The Lok Sabha election dates have been announced, and 7-phase polls to be held from April 11th. I don't think we've seen this too often. In fact, I don't remember the last time we had a 7-phase Lok Sabha poll, but this is happening in a lot of districts and a lot of phases. So we'll talk to Sanjay Pugale about that. But yes, do monitor this. And from a week's perspective, if you are indeed a global market watcher, there is a really important event that is going to happen. Theresa May is going to put the Brexit deal to vote for the second time this week. If this doesn't happen, there needs to be a decision taken about a no-deal exit or an extension. A lot of people are talking about an extension, so this becomes very important from a UK economy watcher perspective. However, doesn't have too much of a bearing on our markets as of now, at least. So what does have bearing on our markets? I think a bunch of stocks that will move around. A lot of large caps could move around as well. So let's take stock of the 3 or 4 most important pieces of news which could make the stocks react. Firstly, NTPC, Power Grid, arguably even NHPC. Just to take a moment to explain, CERC has released the final norms for the period of 2019 to 2024. Now, these norms are less stringent vis-a-vis the draft norms and are ROE accretive. Regulations have kept the regulated ROE unchanged at 15.5. I think the expectations were that they would be ROE dilutive. That hasn't happened. So the worst was anticipated. That hasn't happened. Maybe that's why NTPC did reasonably okay in Friday's session too. People might have gotten a whiff of this. But now that it's happened, let me tell you what brokerage is saying. IIFL is saying that NTPC, Power Grid, NHPC all could react positively. Citi believes that the norms are marginally positive for NTPC and marginally negative for Power Grid, so a bit of a dichotomy here. But I would reckon that since the ROE, regulated ROE has not been changed, this should be positive. The question mark only is, can NTPC react more after the 4% uptick that we've already seen? Remains to be seen, but the news at the margin is positive. News is positive for Hindalco as well. The subsidiary Aleris posted very strong Q4 numbers, stronger than expected shipments in Europe division as well, higher profitability in the North America and the Asia Pacific divisions, and the guidance has been strong too from Aleris. So all of this should augur well for Hindalco in the session today, but metals have their own way of reacting, so you don't quite know what could happen. Dredging Corporation, the government has sold that 73.44% holding in the company at a 17% premium. Now, the way it has been done, the methodology, everything, you could, I mean, one way or the other, you could argue about how it's been done and does this set a precedence or otherwise, or does it adhere to what the norms have been in the past. I won't get into that right now. All I'll tell you is that the deal has happened at 70% premium at 510 rupees. Let's see if Dredging Corporation reacts to this or not. CG Power and Industrial Solutions going to reclassify 7 of discontinued operations as continuing operations with effect from January 1st. The non-cash impact of such reclassification expected to be out 200 crores. The CFO has resigned as well. They appointed a new one, but the CFO has resigned too. Let's see if CG Power and Industrial Solutions react. And last but not the least, since I'm going to speak a lot more about it, I won't dwell too much on it. Just keep in mind, SBI, very important. It's a big landmark shift. They've announced a new model for setting saving deposit and lending rates. They've linked the interest rates on savings deposits above 1 lakh rupees to the RBI repo rate. Lots more to this, and I'll talk about it, but just keep this at the back of your mind. And on first word today, most of SBI's deposits and advances now directly or indirectly linked to an external benchmark. I take a closer look at the lender's new rate regime. Analysts still have faith in the worst performing city gas distribution space. Sumit Sarkar will tell us why. Then Darshan Mehta will tell us how IPCA Labs plans to build on signs of recovery seen this year. And as the country gets set to head into general elections next month, Sanjay Pugalia will join us to tell us what we need to watch. Okay, the big news, and I'll just dwell on it a little bit and tell you what brokerages have made of it. SBI's new rate regime. Savings accounts with deposits above 1 lakh rupees. So it's become the first lender, domestic lender, to link its interest rates to an external benchmark. Most savings account deposits have now been linked or will be linked to Reserve Bank of India's repo rate. This also effectively links all loan rates to an external benchmark. Let me first try and simplify this for you. So firstly, savings accounts with deposits of above 1 lakh rupees, they have been priced at 2.75% below the repo rate, which means the effective rate would be 3.5%. This is effective from the 1st of May. Cash credit accounts and overdraft facilities over 1 lakh, the benchmark is the repo rate. The price is 2.25% above. Therefore, the effective base rate would be 8.5%, and there's a risk premium depending on the credit score, again effective from the 1st of May. There is an indirect link. Because a bunch of SBI's deposits are in this category, the retail and corporate loans, while will continue to be linked to 1-year MCLR will likely adjust quicker as cost of funds will move with policy change. I think most brokerages are saying that if the repo rate gets cut by 25 basis points, the MCLR would get adjusted by about 7 to 10 basis points as well. This too, remember, effective from the 1st of May. And therefore, the fixed interest rates, which means that there is no change in which are the rates in, or which are the accounts in which there is no change. Well, savings accounts with balances of up to 1 lakh rupees that stay fixed, and borrowers with cash credit and overdraft of up to 1 lakh rupees that stays unchanged. Now, before I get to what brokerages have made of it, we spoke to PK Gupta, the managing director of SBI, and he had to say that about 80% of our total savings, I'm quoting him, about 80% of our total savings deposit book consists of deposits of over 1 lakh rupees. So this will impact a lot of our customers. Moreover, while calculating the marginal cost lending rates, which is the MCLR as people would know, savings deposits have a 40% weightage. So this linking will also have a bearing on overall loan book. This happened on Friday. Now, what to make of this? One, of course, that the deposit rates come off. So how many people will go out and continue with the deposits or make fresh deposits? That's one question with SBI. But a lot of brokerages believe that other banks have to follow suit. So let me tell you what brokerages have made of this and what is the verdict on State Bank of India, because that's what we want to discuss here, right? The impact on State Bank of India. Firstly, Morgan Stanley, in its note on SBI move, says that the move could actually reduce margin volatility over time. This seems to be a consensus view amongst brokerages, by the way. They also believe that other large banks will follow SBI's move. They believe there is no choice out here. And they see limited impact due to any potential moderation in savings deposit growth for SBI because they are in a much better liquidity situation. So the fear or the belief is that maybe, just maybe, depending on how the other banks react, there could be moderation in savings deposit growth. But even if that were to happen, they do not believe that it will be a big negative for State Bank of India. Citi, they say that the move could lead to a faster monetary transmission and could address RBI's concerns. Also, SBI's approach could help limiting the ALM risk for banks at large if all the other banks also tend to move to this. This is because both sides of the balance sheet, for any bank which does this, both sides of the balance sheet will be repriced with movement in policy rates. Otherwise, there could have been a mismatch out here with asset side and the liability side. But if indeed banks do this, then both sides are repriced, and therefore any cut or rise in the repo rates will have an equal bearing on both the assets and the liability sides, and therefore no mismatch, which should only be positive for an ALM from an ALM perspective. So, well, the brokerages seem reasonably confident or reasonably unperturbed about what this would do to SBI's deposit rate. They believe most other banks will follow suit, and over time this will reduce margin volatility, which should actually be viewed positively. It's not as much a stock mover, but it's a big newsmaker and a landmark shift of sorts. Let's see what the other banks do. We'll of course have a conversation about this with a banking analyst at about 8:30, so keep that at the back of your mind. Moving on to the next piece, the country's largest city gas distributor has not been doing well in the stock market. It has consistently been lagging peers, but analysts remain bullish. Samit Sarkar is standing by to tell us why. Samit, good morning.
Good morning, Raj. So if we see in the last 1 year, Gujarat Gas has been consistently underperforming its peers, that is Indraprastha Gas and Mahanagar Gas. And this is despite strong growth prospects expected from the company. So why? So what is it that has been ailing the share prices of Gujarat Gas? Now that is the volatile margins. So if you see the unit margins earned by Gujarat Gas has remained fairly volatile compared to its peers, and that is because the company receives a high share of its revenue from the industrial segment. Now in India, if you see, the city gas distribution companies are mandated to use the imported gas for industrial use, while this domestically produced gas can be used for household and transportation purpose. Now this the prices of the imported gas are linked to market linked and prone to fluctuations. Also the gas that is supplied to industrial segment competes against cheaper alternates like coal, coking coal and petcoke, because of which price hikes become difficult for a city gas distributor, and thus we can see a volatile margin when it comes to Gujarat Gas. Now if you see the margin trend for Gujarat Gas, it has it has gone as high as around 8.1 rupees per standard cubic meter, while it has fallen to a low of close to 5.6 rupees per standard cubic meter. For IGL, if you see, it has remained in the range of around 10.5 to 11 rupees, while for Mahanagar Gas, it has remained in the range of around 12 to 13. And because of this volatile margins, analysts are not giving, investors are not giving a higher valuation to this stock. But analysts still continue to remain bullish on this stock. If you can see the ANR page of Bloomberg, you can see nearly 85% of the analysts tracking this stock have a buy rating for this stock. So why is that? Firstly, if you see over the next 2 years, the volume growth expectations from Gujarat Gas are fairly high when compared to its peers like IGL and Mahanagar Gas. Now over FY19 to FY21, Gujarat Gas volumes are expected to grow at a compounded annual growth rate of around 12%, while that of IGL and MGL are expected to grow at a CAGR of around 8 to 10%. Now this strong volume growth is on the back of two regulatory drives that have recently recently happened. First, if you see, it has won the highest number of city gas areas in the last 2 auctions. Now, in the last 6 months, the gas regulator, that is PNGRB, has concluded 2 city gas auction, which is India's 2 largest city gas auction. And in these 2 auctions, Gujarat Gas won nearly 7 areas, while IGL won close to 4 areas, and Mahanagar Gas has managed to win none of the areas. Along with this, if you see, the National Green Tribunal also recently ordered the polluting ceramic units in Morbi to convert their units to gas usage or to shut down their operations. Now, in Morbi, Gujarat Gas is the sole supplier, and currently only 50% of the units in Morbi operate on natural gas. So, if you see, in the current region also, the potential volume uptick could be high if these remaining 50% shift to gas from current polluting fuels that they have been using. And lastly, if you see, the consistent fall in the gas prices in the international market could also aid the company's financial. Now, if you see the Singapore LNG prices in the last 6 months, they have halved in value due to excess global supply over demand in the international market. Now, this fall in LNG prices in the international market would aid companies' margins in the industrial segment, thereby boosting their overall margins, not only in the ongoing quarter, there is the 4th quarter of financial year 2019, but also in the next financial year, that is FY20.
Okay. Sumit, thanks for putting that into perspective. We will watch out. Well, brokers are certainly watching out for Gujarat Gas already, and maybe they're watching out for some other companies too, because the next stock is also a stock that is not necessarily news, but on the minds of a lot of people. US FDA woes and a major order cancellation in its institutional business had hurt IPCA hard in 2015. The Mumbai-based drug maker since then has seen margins drop and is still trying to find its mark in the export markets. Financials in the first 9 months of the current fiscal show some recovery though, something that the management will hope to build on. Darshan Mehta is here for more. Darshan, good morning. Why IPCA Labs today?
So basically what happened was, like we spoke in Ajanta, what it's doing, because there also the institutional business was hurt. IPCA, the case was once the FDA business collapsed there and the institutional business, because of this import alert that moved out, that has been facing a lot of risk. So the main reason we are trying is that, we're showing what has happened, and the management met a lot of institutional investors recently. In post the 3rd quarter number, they didn't give an official guidance as such. Now they've started giving out guidance, so we'll dwell on all of that. First of all, if you take a look at the revenues, from 2010 to 2015, on an average, they were clocking close to 20% revenue growth. In 2015-16, there was a big drop because of the US business miss, and you can clearly see that, post that they've slowly and started building out. Again, 15% revenue growth in the first 9 months of the year. So that has been strong. Even margins, again, coming back to levels of 25%. They went as low as 12 to 13% earlier. Now, again, in the first 9 months, they indicate that the margins are 25%. What has the management said in the meetings with analysts and investors recently? First of all, now they've given a guidance. They believe for the next 3 years, the top line growth will be in the range of almost 12 to 13% growth that will come in, and margins will be in the range of 24 to 25%. They believe that their utilization of their plants will aid them, and because of the plants that are there, they will have a big operating leverage that is there, because they're incurring fixed costs, and if the revenues start coming in from the other verticals, the operating leverage on the plants actually goes up. So that is how they expect to improve margin. They expect a chunk of the institutional business to come back to them, what had gone out because of the plant issues, and they believe that there will be ramp up in the UK and branded generic business that will help them. So this is basically the overall strategy that they have.
And how do they plan to achieve all of this?
Yeah, so there are 4 or 5 pockets we need to say, because they give guidance in each of them. First of all, the plant issue is there because all 3 of their plants are under import alert. So basically the US business is off for them. What they have said is the fact that the remediation at the Pithampur and Silvassa plant is over. By March, they expect the Ratlam plant to also have that, and post that they expect the US FDA to come in. They expect that in FY19 itself, they expect the plants to be cleared by the US FDA. So from next year, they probably will start getting the US business soon. For the India business, they expect a 14 to 15% top line growth in the 4th quarter. So they are rather bullish on it, and a consistent 13 to 15% growth from the formulation business in India for the next 3 years. So that is their strategy for India. As far as the international business is concerned, the formulation business is expected to grow at anywhere between 10 to 15%, and the generic business, which has not been doing well, they expect that was hit because of certain one-offs. they believe that next year around the generics business will also be normalized. As far as the institutional business is concerned, they've done 125 crores of top line in the first 9 months. They believe that for FY19 they will end the year in the institutional business of 180 crores. The new products that they have launched will actually aid revenues for them, and they believe that the global fund, again, orders will start again coming back for them for the institutional API business. So expect to grow there. And for the API vertical, they are saying that they hope to grow almost 20% in the next fiscal. So now you are with IPCA, which actually has no US revenues, but now has started being optimistic. If you see the stock price, that has also reacted very positively, coming in very close to its all-time high again, because they have started doing stuff in the other verticals to make up for the loss that they had in the US. And once this US business comes in, what analysts say, they haven't in their estimates considered the US business, because still it's under import alert. And if the management is saying by FY19 they expect the plans to be clear, probably the APS estimates might change if anything happens much sooner than what was anticipated.
Okay. Let's wait and watch. Thanks, Darshan, for bringing us that perspective on IPCA Labs. Remember, so a lot of these analytical pieces on First Word, and then we've, of course, spoken about all the key stocks that could move around, the power names, Jet Airways, and a few others. The big news, of course, is about the elections, because India, now it's officially out, India will hold Lok Sabha elections in 7 phases from April 11th, to May 19th. And the counting will take place on May 23rd. But that's not all. The Election Commission will also hold simultaneous assembly elections in Andhra Pradesh, Arunachal Pradesh, Odisha and Sikkim, and by polls to 34 constituencies. The Jammu and Kashmir assembly polls, however, have been deferred, citing the security situation there. Joining us now to talk about the largest democratic exercise that's coming up next month is Sanjay Pugalia, editorial director at Quintillion Media, joins us right now on the show. Good morning, Sanjay. Thanks so much for joining in. First, your opinion on anything that stood out for you and sounded slightly different from what you've seen in the past in your vast experience. I just thought that the whole 7 phases in a bunch of areas, including the northern states and West Bengal, was slightly different from what we've seen in the past.
Yeah, exactly. That is the biggest highlight, that states like UP, Bihar, Bengal, they will be going for polls in all 7 phases. Generally, Election Commission tries to finish the election in maximum 2 to 3 phases in each state, even though they are big states. But spreading them into 7 phases raises some questions, of course, from the opposition quarters. But Election Commission says in the wake of security situation, in order to deliver a very good, efficient elections, we have spread it over 7 phases. The second highlight, as you mentioned in your introduction, that Jammu Kashmir assembly election are being postponed. If you can hold Lok Sabha election, why can't you hold assembly election simultaneously? So that decision is quite controversial and bit disappointment in the wake of the effort by the BJP to frame the election on the national security issues. So this reflects very poorly on the governance.
Interesting. Any material impact, Sanjay, to your mind that could happen? Because as you said, we've already seen statements coming in from certain quarters of the local state bodies like the West Bengal government, for example, on these 7 phases. They've of course said that this will inconvenience people, but it's something that they probably didn't anticipate, or it doesn't quite work that way. What did you make of this particular thing? UP, West Bengal and some other places, 7 phases.
Yeah, look, because for BJP, West Bengal is a greenfield project, while retaining UP and Bihar is most critical for their objective of getting near majority seats compared to 2014, because they broke all possible records in North Indian states by garnering 90% seats of 60% seats in this country. So that will be a difficult task. But coming to the election schedule, what this does is now campaign really doesn't stop 40 to 48 hours before the actual polling, because you are addressing rallies in some other areas, and that influences the area where you are going for polling the day after. So this allows lots of distortion. That is why opposition gets certain disadvantages and the ruling party has certain advantages. So these are very critical states politically, so it will be debated till the elections are over. that this helps the NDA, and this is disadvantageous for BJP because BJP will, for the opposition parties, because BJP will have an upper hand in campaigning. And these are grey area issues where Election Commission is not giving any clarity that you are addressing a rally in the nearby town, and while election is going to happen, election is actually happening on the day of polling, and you are addressing rallies in the other areas. So that vitiates the atmosphere to some extent.
Well, yeah, expect it to be. I think that's the right term, vitiates the atmosphere. Sanjay, one question on the Maharashtra thing, not that you mentioned it, but there were some quarters saying that even Maharashtra could be, the assembly could be dissolved and simultaneous elections could happen. Were you anticipating that? And is this a surprise that it's not happened?
No, after in Maharashtra, Shiv Sena BJP alliance was again regrouped. It was possible and it was speculated that Maharashtra Assembly will also go simultaneously in this poll only. But I think in Maharashtra they are feeling safe. They are not seeing a great risk. So they have not included any other big state in this schedule. Mainly, BJP has been talking a lot about simultaneous state assembly elections and Lok Sabha elections. That is why that anticipation was there. But I think Maharashtra, they are feeling safe politically, so ruling party is in no hurry to push elections there.
Okay. My final question, Mr. Pugalia, and that is on this one move that I think a lot of people will laud. It started with the BJP MP wearing that army uniform, and I think Election Commission has disallowed any kind of campaigning on that front. That should be viewed positively.
Election Commission has given a very right instruction. So what may happen, my fear is that any political party formally, officially will not misuse the role of military in recent developments on the border with the skirmishes with Pakistan. But unofficially using other organizations and entities and individuals, they will keep distorting and misusing all these things. So will Election Commission be very forceful in getting these parties to enforce and not allow their so-called supporters to misuse our armed forces, paramilitary forces in election battle? Is something that we have to watch and see. Similarly, Election Commission has talked about pre-certification of advertising that will happen on digital media and social platforms. But social platforms are again being misused by the well-wishers and supporters. How are you going to stop that is still a big question mark.
Okay, Mr. Pugalia, as always, really appreciate you joining in today and giving us that perspective. Thanks so much.
Thank you.
That's Sanjay Pugalia, editorial director of Quintillion Media, talking about his thoughts on the few changes that have happened from the past in yesterday's announcements by the Election Commission. But the official news, April 11th to May 19th, is when the largest democracy in the world will go to vote. So that's a big event. That's all that we have on First Word today, though. Quick programming note, we discuss markets and macros with emerging equity market strategist Adrian Mowat. He will have some thoughts on what all of this means for the markets as well. Talk about the new CARC tariff regulations as well as the PPA norms, the changes thereof. We'll be joined by Power Secretary Ajay Kumar Bhalla. And then we speak to Mayank Singhal of PI Industries on how their quarter went by and how will China's shutdown benefit Indian chemical companies and more. But after this break, a full tilt towards the day's trade. Stay tuned to Bloomberg Live.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. Only on Bloomberg Quint.
Hello and welcome. You're watching IndianOpen right here on Bloomberg Quint Live. Good morning, Neeraj.
Morning, Devina. It promises to be an interesting day of trade. Flat starts, but bunch of stocks in news. And now we are in the election mode officially.
Yeah, and last week was a real bumper week for the indices. Whether or not those resistance levels kick in and we see profit taking, particularly on the index, is something that we'll have to wait and watch, because today's trade setup, at least in terms of what the rest of the globe is doing, is not all that great. Even for Asia as a pocket, it seems slightly, while you've got Nikkei 225 up a quarter, Shanghai is up. You've got some pain points coming in from the US as well. SGX down about 0.2%. Remember, we've already seen that big run up in last week's trade. We'll see how this trade shapes up this morning. But let's bring in Bhatia to talk a little bit more on the derivative side and what did Friday's session culminate into. Agam.
We did see about a little more consolidation last Friday, even though the indices closed marginally in the red. The futures did very little action, saw very little action in terms of a change in open interest for the Nifty, and the case was the same for the Nifty Bank, with less than 1% addition in open interest towards, well, at this point in time, no indications towards short or long. The India VIX came off and went below the mark of 15, and this should be another positive for those who are betting against volatility in the markets over the next few days. When it comes to change in open interest, we're not really seeing too much, except for perhaps some like 11,100, 11,200 standing out in trade. This, of course, is your open interest distribution for the upcoming expiry, the coming expiry this week. But let's move on and talk about your put-call ratio, which has come off to a certain extent to 1.6. The Nifty banking put-call ratio, on the other hand, rising to around 1.2. And, three stocks in the F&O ban, IDBI Bank and Reliance Power, with Jet Airways, which is the new entrant in the ban. Wockhardt, on the other hand, comes out of the F&O ban, so keep an eye on that one as well. And in terms of other stocks that I'm keeping an eye on, let's pull up that list of stocks which are seeing an increase in open interest, and that should come up on your screen soon, in any moment. In any case, I would keep an eye on several stocks which are seeing a lot of increase in open interest, which will include stocks like cement companies, which are expected to see a further impetus, and of course a handful of stocks out there which are seeing changes in brokerages, which include United Breweries as well as United Spirits. But on the whole, we're expecting another day of consolidation, but perhaps some mixed cues coming in.
Agam, thanks a lot for that. That's the F&O wrap-up for you. But down to the big news of today. SBI becomes the first domestic lender to link its interest rates to an external benchmark. Most savings account deposits have now been linked to the Reserve Bank of India's repo rate starting May 1st. How's the street reading into this development? Let's talk to Siddharth Purohit of SMC Institutional Equities, who's joining us right now on the phone line. Siddharth, thanks very much for taking out the time. This is obviously a big move from SBI, nonetheless preemptive, because while RBI had stated this 2 monetary policies ago, they'd really not placed a deadline for any of the banks to actually come out and take this measure on board. How did you read into this this step that SBI has taken, and do you see other banks following suit?
Hi, and morning. In fact, when in the last monetary policy, RBI gave the kind of guidance that banks should link their rates to some external benchmark. So naturally it would have been either the GSEC or maybe repo, and GSEC being very volatile was not a sensible idea, so repo was the natural choice. And SBI being the leader always takes the kind of lead in deciding any sort of rates. Now, based on this move, I believe that if you look at currently there are two rates which has been offered by SBI, particularly for the saving bank side, particularly up to 1 crore and above 1 crore. So up to 1 crore it was around 3.5%, and above that it was 4%. But now the current move says that only there will be two differentiations, up to 1 lakh and above 1 lakh. So the deposits up to 1 lakh has not been kind of will not see a lot of volatility, because it will be kept at 3.5%. But only above 1 lakh is what that will see some kind of volatility, maybe in terms of whenever there is a change in the repo rate. And now that we are in a trending a scenario where the interest rate can further come down. So possibly when now, as I said, there is a rate that has been kept 2.75% lower than the repo rate. The deposit rate has been fixed. So if let's say repo rate further goes down, then definitely the cost of deposit for SBI will also come down. And let us understand one thing, that SBI has one of the highest CASA ratio among the PSU banks, and even compared to other banks also. So close to 45% plus. So I think high CASA ratio and a lower rate will definitely result in some amount of easing up cost of fund for the bank. And that should be marginally be positive for the margins. Very difficult to quantify how much would be the margin, change, maybe positive or negative. But certainly, my understanding is that it should be positively impact the NIMs to some extent, because CASA being a big part of the deposit will definitely impact it.
Sure. So it does definitely look more positive for SBI. I just wanted to get your opinion on the asset liability management. So, while we are talking about MCLR loans having an impact of about 7 to 10 basis points, that accounts for closer to, I think, 70% of the book for SBI in terms of the overall loans, and the deposits account for about 32%. So the impact of a 25 basis point change on the repo rate will have a differential impact because of the weightage that both have on the asset side and on the liability side. Is that a little bit of concern or not? Not much.
I don't think there will be a major change in the asset liability side. The reason being there has been a corresponding change in the the lending rate also has been kind of pegged to the up to above 1 lakh has been pegged to the repo rate, and that has been pegged at 2.25% above repo rate. So while there is a change in deposit rate, there will be a change in your lending rates also, and it's difficult to quantify how much is below 1 lakh and above 1 lakh for the cash credit and the normal rates. But again, the retail lending has not been changed. It will again be continued on the MCLR based. So I don't think in the near term it will not really change much towards the asset liability side. But on a positive side, it can change because the cost of fund will certainly be beneficial for the bankers as of now. But I think one should wait for 1 quarter to see how actually cost of fund does move because of this. Because a large part of the borrowers or the corporate lenders will kind of also come under this mechanism, and the spread on that will really impact the profitability of the bank. So not too much worried about ELM side. Right?
Fair call. Siddharth, appreciate you joining in this morning and giving us your thoughts. Thanks so much.
Yeah.
That's the view from Siddharth Purohit of SMC Institutional Equities. Let's see. Most brokerages believe that the other banks will follow suit as well. Avinash, Gorakshakar with us. Avinash, would there be a stock price impact, not just necessarily right now, but over the next couple of quarters once this comes into effect for State Bank of India?
Yeah, I think, Neeraj, definitely this would be playing out on other banks also. And I think clearly SBI being the lead in this, obviously we could see some sort of traction initially on the SBI counter, maybe not in the short term, but at least in the near term. Our sense is that this definitely would improve the costing mechanics for most of the PSU banks, and I think this is as per the RBI policy. So I think it's going to happen for most of the PSU banks, and hopefully in the next, say, 3 to 6 months, you could see a lot of announcements from the other PSU banks coming in.
Interesting. Before we talk about today's stocks and news, a couple of things that I wanted to talk about, Avinash. This whole conversation that happened around Arvind Fashion's listing and the fact that the discovered price was way lower. Now, we can get into merits and demerits of that process, but my question is, for somebody who's holding on to Arvind Fashions or somebody who wants to get into Arvind Fashions, would you believe that there is some more time left before the stock will give up its upper circuits?
I think, Neeraj, clearly, the kind of price what we have found, which was discovered on the initial day, I think liquidity still seems to be pretty low. And I think, for the first 8 days, I believe the stock is into a T to T kind of transaction period. So obviously, this price is not the fair price. Typically, on a fair value basis, I would suggest that, around 1,000 rupees would be the ideal fair value, based on the current valuations. Clearly, I think somebody who does manage to get this stock would definitely gain in the near term. But my sense is, I think getting the stock at this price would be a bit difficult because liquidity in this counter is extremely low.
Okay. Just before we get to our research team huddle, a piece of news that has come in the new CERC norms, Avinash. Did you get the chance to read them? And what's the impact on the three names, NTPC, Power Grid, and NHPC?
No, I think we have already seen some price rise, especially as far as NTPC is concerned. And I believe, these CRC norms, if they do get implemented, as fast as possible, you could see, these power companies typically generating much better cash flows. In fact, the markets were awaiting this CRC decision from a long time. And I think clearly, once this happens, you could possibly see a lot of these companies actually putting up reasonably good performances. Maybe not happening in the near term, but at least for FY20, the companies could possibly post better set of numbers, considering that there is a kind of a positive impact on the tariff.
Let's wait and watch. I think Avinash's point is well taken that NTPC, for example, has already risen a bit. So let's wait and watch how much more is left out there. Watch out for Power Grid. Brokerages differ on the impact out here as well. So interesting to see what happens to this stock today. However, lots more to talk about, and let's take it to our research team to try and figure out what are the key stocks in news aside of SBI and the CRC norm revisions that have happened. There are some key brokerage calls as well. And of course, metal stocks, particularly Hindalco, will remain in focus. Good morning, all three of you. Let's start off with the stocks and news first, Mishka.
Yeah, so there are a bunch of stocks we need to look at today, starting with Dredging Corp. Government sells its entire stake of 73.5% in the company to 4 state-owned ports at rupees 510, which is a 17% premium. CG Power and Industrial Solutions to reclassify 7 of its discontinued operations as continued operations with effect from January 1st. Non-cash impact of such reclassification is expected to be around 200 crores. Promoters 6.76 crore pledged shares has been invoked by lenders. Avanta Holdings will continue to have the right to retransfer the shares to itself upon repayment of the debt. In the event of any sale of the equity shares by lenders, any amounts received by them over and above the outstanding amount of the debt will be payable to Avanta Holdings. Dilip Buildcon declared L1 for the EPC project in Maharashtra costing rupees 480 crores. The project will be completed in 24 months. Now, Adani Group promoters have reduced pledged shareholdings in various Adani Group companies. Adani Ports promoters released pledge on 2 crore shares. Adani Enterprises promoters released pledge on 62.6 lakh shares. And Adani Transmission promoters released pledge on 81.3 lakh shares. Lastly, lenders have invoked pledge on various Anil Ambani Group companies. Reliance Infrastructure 50 lakh pledged shares of promoters were sold by the lenders. Reliance Power 2.15 crore pledged shares of promoters were sold by lenders. And Reliance Communications 19 crore pledged shares of promoters were sold by lenders.
Well, let's wait and watch. The interesting would be the Adani Group stocks, and let's see if there's a technical reaction there. But hey, good news for Hindalco, Nikki.
Yeah, good set of numbers reported by the newly acquired Aleris, not just in terms of the CY18 performance, also looking forward in terms of the guidance and the way the company could achieve the targets. Quickly, the numbers, Q4, the net loss has actually contracted substantially, $23 million as compared to $107 million. Adjusted EBITDA is up by 65%, mainly driven by the stronger than expected shipments in Europe division, higher profitability in both North America as well as Asia Pacific division. I'm going to buy a minute here. CY18 numbers, if you look at the net loss, look at the number in the way it's contracted, $92 million as compared to $211 million in 2017. Do note 37% of uptake in EBITDA. Now the company going forward has guided a target of around $360 million going forward in FY21. But if we continue with the growth rate of 37% in this year itself, that is CY19, the company could achieve the target. So that is a great positive coming in for Hindalco and the kind of acquisition price for the company. Strong Q1 outlook where the company has guided the adjusted EBITDA for the next quarter to be substantially higher as compared to the previous year. This is despite the cost pressures that the company is seeing growth across all the verticals, be it European, be it also in terms of the aerospace volumes, and in terms of spreads, it expects that to be favorable year-on-year basis, especially for North American division.
Okay, so 37% growth in EBITDA, and let's see if that continues, because that helps Aleris meet the guided EBITDA numbers for FY21. Thanks, Nikki, for that. Agam, what else? What are brokerages saying?
Well, some interesting notes coming in on the UB Group stocks. I'm going to start off with Motilal Oswal. They have downgraded United Breweries to a neutral from a buy, with a price target cut to around 1480 from 1660, and they have upgraded United Spirits to a buy from neutral. The price target hiked to around 700 from 620. The reason here is, as far as United Spirits is concerned, it is trading at a significant discount. The debt reduction is going to aid in terms of profitability when it comes to United Spirits. United Breweries, a lot of positives have already been priced in, which is why it has a relatively, less of an upside at this point in time based on the current valuations. Tailwinds for United Spirits will include capex revival, elections, and antitrust case overhang, which could aid going forward. And we also have HSBC on InfoEdge, where they have actually upgraded the stock to a buy from a reduce, and they've also hiked the price target to around 1978 from 923, and this is largely on the back of an improvement in recruitment, property, as well as food businesses, which are expected to do well. And they do suggest that a lot of these positives are yet to be accounted for in the current market price, which is why they've upgraded InfoEdge.
Okay, let's wait and watch what happens to all of these stocks. Thanks a lot for that, all three of you. Avinash, a bunch of important names out there. Maybe I can ask you whether you think Hindalco will react positively as a result of what Aleris has done.
No, I think, Neeraj, Hindalco should react positively, considering the fact that hopefully Aleris reduces his losses and gets a better kind of EBITDA, and bottom line makes definitely the consolidated picture for Hindalco quite promising. You could see a little bit of bounce on Hindalco, and considering the fact that this acquisition was made some time back, I think most of the analysts are factoring in the fact that possibly FY20 could see the EPS getting accretive from this acquisition. So I would believe that yes, it's a positive sign, and I think hopefully as we get more and more earnings momentum here, we could see that kind of rub-off on the Hindalco counter.
All right, stay with us, Avinash. Lots more to talk about, but let's bring in our technical experts. Brijesh, Bhatia, Head of Research at Dealmoney Securities, is joining us on the show. Along with him, Gaurav Bissa of LKP Securities is also here. Gentlemen, good morning to both of you. I'll start off with you, Brijesh Bhatia, on your index call, now that we are looking to make that approach towards 11,100.
Yeah, definitely. If we look at the momentum, index is quite strongly holding 11,000 levels now. And if you look at the previous momentum, 10,980, 10,985 was majorly holding a resistance zone. And in this time, we have seen a gap up opening strong above 11,000 and seen a 11,080, 11,070 levels on the upside. So I think a test of 11,000 on maybe 10,985 could be a good on the spot, could be a good level on a buying opportunity. and keeping a momentum target of around 11,080 on the upside, because I think 11,085, 11,090 might act as a minor resistance zone technically before moving higher. But definitely 10,985, 11,000 could be a good opportunity. And if you look at the derivative structure, we have seen that monthly the range has been now shifted from the highest put at around 11,000 levels. And even if you look at the weekly, it is around 11,000 put, which are holding around 16 lakhs, as well as monthly are holding around 34 lakhs. So I think 10,985, 11,000 will act as a now major support zone for bulls, and one can look for buying opportunity, keeping the target of momentum around 11,080. And I think once it breach around 11,100, 11,230, 250 on the upside could be eyed in the movement.
Okay. What about you, Gaurav Bissa?
Good morning. If you look at the kind of movement that Nifty as well as Bank Nifty has seen, we have seen the range shifting, as Brijesh already mentioned, that the range has been shifting as far as the put writing is concerned. Having said that, one also needs to look at the previous high level or the previous resistance area of 11,100, 120. If we try to conquer those levels and again reverse from that particular level, if you look at the option chain as well, 11,100, 11,200 are seeing decent amount of adding happening. So there's a comfort zone that we are seeing right now where 11,000 put writers are quite comfortable, 11,100, 11,200 call option writers are quite comfortable. This generally shows that Nifty will continue to trade in a range 10,950, 11,120. That would be the broader range that I would be talking about for next few trading sessions. I don't see a trigger yet happening. Yes, we are trading above the crucial psychological mark of 11,000. That is the only positive. But having said that, it is going to be a daunting task, a Herculean task for Nifty to sustain and manage above levels of 11,000 mark. For me, Nifty as well as Bank Nifty both are going to be stuck in the range. Bank Nifty is looking a tad bit better because it gave a good breakout and it's trading above the breakout levels. For Nifty, it is going to be in the range overall.
Okay. Let's get in some stock ideas as well before we go on to our Bloomberg Edge segment. Gaurav, I'll come to you for your stock ideas.
My first recommendation today would be a buy call on Petroid. This is one of the very few mid-cap names that has been consistently adding long positions, decent rollovers, good momentum was seen, did not see too much of correction in spite of a lot of these mid-caps witnessing great correction. It is now on the verge of giving good breakout. 2% long additions were seen getting built on Friday's trade. So again, the stock looks quite interesting. One can play for target of 240, keep a stop loss of 231. Second recommendation would be sell on Infosys. A consistent short position is seen getting built. It's given a breakdown on daily charts as well. I would recommend a sell and rise towards 720, 722 with a stop loss of 732. One can play for target price of 690 and below.
Okay. We'll come back to ideas from Brijesh in a bit, but time now to bring on board our special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock. Yash, what's the stock on your radar today?
Morning, Devina. So we are tracking Infosys on the charts and a sell signal coming on the back of the proprietary Bloomberg indicator, which is the trender indicator. Before we start, as usual, let us try and understand what the trender indicator is and how do you interpret it. It basically uses the average true range for the purpose of calculation, and it generates a buy or a sell signal and also helps you manage your stop loss. How do you interpret it? You go long when the trender flips its color from red to green, and you go short when it goes from green to red. In the case of Infosys, that's exactly what has happened. As you could see on the price chart over here, the green line over here, that is the trender line, and it was at the mark of about 721.47. What we've seen over the last 4 trading sessions or the last week is that the stock has been consistently falling, and on Thursday it came very close to that mark, but it managed to close above it. But Friday, what happened is that it fell significantly on the back of very heavy volumes as well, and it has closed below that mark. It closed at about 712.35, indicating a flip in the color. We have seen the stock move up quite significantly in the recent past, and the green, and every time that the indicator has turned positive, it has seen big up moves. But over the long term, if you see in the 5-year charts, we don't really have that to show, but over the long term charts, the red bars, whenever they have come in, it has gone down significantly as well. It gave a false breakout somewhere over here, but again, it seems like the trend is on the downside when it comes to most of the IT names as well.
All right, and how well has this worked in the past for Infosys?
So 6 out of the last 8 times, Devina, that the indicator has turned negative, well, it would have gone down by at least close to 4% over the next 10 trading sessions.
Okay, Yash, we'll leave it at that. Thanks so much for joining in and giving us that note. We'll talk about IT stocks in a bit, but first get in stock recommendations from Brijesh. Brijesh, good morning. Your ideas for the morning.
I would have two long stocks. First is Exide Industries. So if you look at the Exide Industries, it has formed bullish AB equal to CD harmonic pattern. Plus, if you look at the weekly chart, it has seen a strong rebound from around 200 weekly averages. RSI has now moved above 40 levels from testing about the 30 levels on the weekly charts. So I think it is showing a strong upside momentum, and at around 224, one can look keep a stop loss of last week low, which was around 208. Slightly below that 217.65, and look for the higher target of around 234, 246 on the upside on Exide Industries. Second is Godrej. So if you look at the momentum, it has formed a bullish bet on the daily chart. Plus, if you look at the RSI, it has moved above 50 mark, which is now into the bullish zone, forming the higher low formation. MACD has given a positive crossover on stocks. So one can look for a buy Godrej Industries, keeping a target of around 548 with a stop loss of around 492 on the downside.
Okay, we will watch out for some of these names as well. Now, the other set of stocks which are in news today, one of them has to be Jet Airways. It's a story in the Mint, but about some loans likely to have been given to Jet Airways from PNB. 2,000 crores, I think, is the number that they're speaking about. If this is true, it would be a big positive.
Yeah, I think Neeraj, it would be a small kind of lifeline for Jet, considering the fact that they are living by the day, and technically I think fund infusion is very important. I think the deal which has been talked about by the management and hopefully awaited by the markets is yet to happen. So I think this kind of funding is definitely a positive surprise in the near term. But I think clearly this doesn't change the operating metrics for the company. This just gives a little breather for the company in the sense that their working capital could be funded by these funds. So overall, I think a small positive, but a bigger recovery can happen once the deal happens at the price at which the market is expecting. Currently, there are expectations that possibly it could be at a small premium, and if that happens, we could see a good re-rating here.
What did you make of the big move that happened in Advanced Enzymes? Do you track that company out of the blue, the block deals and that 16% move?
No, in fact, Neeraj, this stock has been beaten down very badly, considering the last 1 or 2 quarters have not been very good, but they are a large player in the enzyme market and largely an export player. They control a very large market share of more than 40 to 50%. So I think the overall business metrics has been quite good. Unfortunately, the margins have not been up to the kind of street expectations, and I think this buying has come in from some Middle East fund. How the numbers pan out would be very interesting to watch out, but overall, the way the stock has gone up by 16-17% in such a short time, I would believe the stock would consolidate now and probably would await for better earnings numbers. Once the earnings visibility comes in, you could possibly see the stock possibly getting further re-rated.
NTPC was a big mover on Friday's session. It was a top gainer on the index in the last half hour of trade at 152. A preemptive move probably with regards to the CERC recommendations. That's the 1 month graph, which is up about 16.5%. Brijesh, what would you do with NTPC if you probably had the opportunity to enter at slightly lower levels? Would you book out of it?
No, I think one should clearly hold. I think 158 is the 58 to 164 is the level I'm eyeing on NTPC. So every dip, I think 148, 49 could be a slight retest, and one can look for a buying opportunity again, keeping a strict stop loss of 144. 162 is the levels we are eyeing on the upside. So still a good upside, 4 to 5% upside left on the stock. So one should hold on their long positions.
But I'm guessing I get your question, because 14-15% move already in the run-up, big 4% move in Friday's session as well. I'm guessing some quarters of the market would have preempted something like this happening, because the expectations were of a drop to 14% and that hasn't happened. So yeah, pertinent point. Let's see. I think the interesting bit, Devina, was also that how some brokerages were divided on the impact that it has on power grid as well. Some believe it's positive, some believe it's marginally negative as well. So interesting to see what happens there too.
Well, the other part for NTPC being, with the high-level empowered committee recommendations suggesting that a nodal agency could be an aggregator for some of the smaller stressed-out power generators. NTPC being one of them is what is recommended and suggested. So whether or not that has a bearing of any sort on NTPC is also something that we'll have to figure out in due course of time, and probably pose some of these questions to the Power Secchi who joins us later on in the show. But just from your point of view, not just NTPC, but Gaurav, Bissa, the rest of the pack, even the private players, the last 1 month or so have seen run-ups in stocks like Adani Power. You've got Tata Power also, which is run up. How have you played the entire space?
To be quite honest, some of these names took us by surprise. If you look at these names, these generally don't move too much and too fast in such a wonderful fashion. But this time we saw a collective move coming in many of these names. So among these, I think Tata Power is one that is yet to see momentum. It's bounced back from the crucial support area of 67.70, but it has not seen a very stupendous up move. So I think this is one name that can be on the radar. Probably a position target of 80-82 is what I would be expecting. Apart from that, Power Grid is another name. It has bounced back from strong support area of 180 and headed towards 183, 184 is a good buying opportunity. Keep a stop loss of 178 on the upside. 200 is what I would be expecting. NTPC and Adani Power, I would wait a bit because they've already seen a strong up move happening. And as you mentioned that some people might have anticipated and we may see some amount of profit booking coming today. So the risk reward might not be that favorable. The momentum is still strong, but the risk reward is not that favorable. So I would skip these names, but probably a Power Grid on dips or a Tata Power is what I would be looking for.
All right, got that. Gentlemen, just stay on with us. 20 seconds left to go for market pre-open. We'll come back and discuss more in just a few seconds. But Asia is a pocket looking okay. SGX Nifty, though, not resonating the same. It's down marginally, just about 0.1% or so. But remember, last week was a bumper week for our markets, even though being truncated. Let's see how this week shapes up. Pre-open ticks on your screen. Nifty opens volatile, marginally higher right now, 1/3% higher. And the Sensex up 0.2%. And what do we have? NTPC 5% higher. That's again just a pre-open move that's come in on the stock of 158, should correct itself. Bajaj Finserv also shows big moves in early morning trade. Hindalco, L&T, that's up 1.9%. Hindalco moves up, Illyris, good numbers there, so the stock doing what it's doing. ONGC is up 1.7%. Bharti Infratel 1.2% higher. SBI, Coal India, Eicher Motors, GAIL, Bharti Airtel 1% odd in the green. Amongst the others, Yes Bank is up as well, 234. Maruti Suzuki 7,000 crossed. Indiabulls Housing, Eicher Motors has been doing well, so 22,000 reached in pre-open. Again, very volatile, so wait for a few minutes. Reliance Industries up 0.5%. Infosys up marginally. Amongst the ones that are in the red, Sun Pharma just 0.25% lower. 4 stocks in the red, the highest loss being 0.25%. The currency at 70. That's what we've got right now. I think on Friday's session briefly breached 70 on the downside, but some amount of move coming in the currency. For the bond yields, that should come up as well, 7.36. So I've been hovering around 7.38, 7.36 since the last few days.
Jet Airways, 6.5 or 7% higher in the pre-open. Okay, those rates are very volatile now, about 2.5. So let's wait and watch. Wonder what Power Grid and NHPC are up to. NTPC started off as the top mover. Power Grid not so much. NHPC again not so much. There's some unnatural moves on SAIL and Nalco and some of the others. I doubt that will last. But let's wait and watch what happens there. Nalco, I don't know. I mean, I don't quite know the dividend date of Nalco, so let me refrain from commenting. But this seems, unless that's happened, it seems unlikely that this move could happen. But let's wait and watch. What else is moving? Ashok Leyland marginally higher, but otherwise not too dramatic. Dabur India, again, I don't know about the reason for the 4% up move, but these rates might just change. So let's wait and watch what happens thereof. And Dredging Corporation and CG Power, there are 2 stocks in news. Let's see what's happened there. Dredging Corp, no big movement. And CG Power, reclassification of some of the earlier operations which were discontinued as continuing operations. We'll talk to Avinash Gorakshakar about that, by the way. And the non-cash impact would be about 200 crores and the CFO resigning, but it's not having a dramatic impact on this one. SBI should be brought up once again because that's arguably the biggest stock in news. I don't know if some of the other mid-size or PNBs, the BOBs of the world have also reacted at all or no, but the belief would be if SBI has done this, almost every other large bank would be following suit. So let's get a BOB, let's get a PNB, and let's see what those stocks are up to as well. About 1% and a quarter for BOB, PNB about 0.25%, but no dramatic moves thereof into any of these. Okay. In a bit, we'll get in a power analyst to talk about what to do with some of these stocks, the NTPCs and the power grids of the world. But the other interesting one, which is in news, is CG Power. Avinash, quick thoughts out here. CG Power, this reclassification, CFO resigning, they're appointing a new CFO as well. What's happening with this stock?
No, I think Neeraj, clearly, this could be a good beginning, but the kind of announcements which have come in would mean that the stock would definitely take some more time to get re-rated. I think on the operational front, there has been no improvement on the EBITDA margins, and I think recently the company announced that they had given about 800 odd crores to a subsidiary. Now, whether that number is that amount is going to come back or not is going to be a key concern for the markets. So I would believe that this is definitely a good beginning, but unless the market sees a very strong visibility on the operating metric side, I would not be surprised that you could possibly see the stock remaining largely range bound, and clearly this is a trader's favorite. Fundamentally, I don't think one should actually venture out at current levels.
Okay, that's the fundamental view. Talking of fundamentals, the power changes that have happened, we got Avinash's view, but the news is that CERC has announced tariff structure for FY19 to 24 for regulated power companies. The regulator has maintained the benchmark return on equity for thermal, hydro and transmission utilities at 15.5, 16.5 and 15.5 respectively. But the third consecutive 5-year tariff regulation period when the regulator is not tinkered with rates too much. The expectations were that it will come down to 14%. Is this a long-term direction on assured returns? Let's ask Santosh Desai of SBI Cap Securities again, who joins us on the phone line from Mumbai. Santosh, good having you. Thanks so much for joining in. A relief of sorts. Can this last longer, or would this be a day's event?
Well, I guess after the draft norms were out in December, it was very clear that the regulator is not going to tinker around much with the base ROEs that you're talking about. So we don't see any surprise from that standpoint of view in the final regulations. Although I should highlight that there are a few points which has come out as positives for some of the regulated entities. Right, we are talking about some of the older plants where the reduction in equity, which was marked during the draft regulations, there is some relief coming in there. The norms which are tightened a little bit in terms of the operational norms in the draft regulations also have seen some breather coming in the final regulations. So all in all, I think you will see some relief coming in the final regulations from the draft, and the base ROE being maintained is a reasonably good positive for the power sector companies.
Do you think on the other side, Santosh, I mean, the tightening of the operating norms for availability and ramp rates, it's not all being given to the generators. There is some positive outcome for discoms as well, which should only help the whole process in a better fashion.
That's right. So if you look at what the regulator's role has always been to have a fine balance between the returns for the companies as well as the discoms, which are eventually the end consumers. So there's a fine balance which is required. So I think the regulator has done a phenomenal job in trying to figure out the gaps when they are trying to do a lot of these things around availability of the power, 85%, and the season in terms of low and high demand season during the day. They're trying to ensure that the power capacity is available to the discoms at the time they need it. Right. So the existing regulations do not really provide for it. The generating companies are free to show unavailability at any point in time during the year and claim the fixed charges. The change now, though, is that they need to ensure that they are available at the time, the peak hours when the discoms actually need power. And of course, the tightening of the norms is a gradual phenomena. Every subsequent regulations, we have seen some tightening coming in there. So I don't think there's any great surprise element out there. But yes, I think the regulator has done a very fine balance in terms of having some returns for the developers on the table, as well as at the same time keeping in mind that the power cost has to be competitive for discoms.
Just one question then, what happens to the stocks now that we've already seen them run up quite a bit ahead of this announcement? How would you value these stocks? What would your pecking order be, if at all, for investment purposes?
Yes. So for our coverage companies, primarily this will hold, for NTPC and Power Grid, a big event is behind us right now. So that was one of the impending concerns, that the regulations will probably squeeze in the ROEs a fair bit for these companies. We don't see that material play out, given that, as I said, it's a fairly balanced regulation which has come across. And, both these companies are trading at reasonable valuations. When I look at NTPC, it's trading at about 1x 1-year forward book, and Power Grid is trading at about 1.4, 1.5x 1-year forward book. So I think these are compelling valuations for one to look at these stocks, now that this big uncertainty is behind with us.
All right, we leave it at that. Santosh, thanks very much for joining, and appreciate you taking out the time. Quick comments there coming in on what this means for some of these power generators now that this overhang has been lifted. Let's talk more stocks then. We're just about at the end of pre-open, and the prices have settled now. We've got some negative ticks coming in on an HCL Tech, which is your worst performer, but not in terms of the quantum. It's just a 0.25% loss. But SBI seems to be that big positive that's come in today, about 1.5% in the session. How would you trade SBI, Gaurav, Bissa?
Well, if you look at SBI, the momentum is strong, but one also needs to understand that we have already seen 265, 268 to around 281, 282. The momentum can take it towards the level of 287 to 288. There is a very strong resistance area. If you look at the option chain, comfortable writing is seen in 293 unit call option. So for me, you use and dip towards the level of 278, 277, keep a stop of 273 on the upside. 287 would be the level I would be playing out for. Beyond that, it looks quite difficult.
Okay. Just stay on with us, gentlemen. We're just minutes away from market opening, and we'll tell you all that you need to know to stay ahead in trade today. First up, earnings for Hindalco subsidiary Lyris improved in the quarter ended December 2018. Operating profits grew 65% and net loss contracted to $23 million from $107 million compared to last year.
DLF plans to raise 3,000 crore rupees through qualified institutional placement by June to prepay loans.
Cash-strapped Jet Airways gets a 2,050 crore rupees loan from Punjab National Bank, according to a Mint report. The company will use the credit facility for working capital needs.
Government sells its entire 73.4% stake in Dredging Corporation at 510 rupees per share, a premium of 17% to Friday's closing price.
Dilip Bilkon has been declared the lowest bidder for a 480 crore rupees EPC project in Maharashtra. The project will take 24 months to complete.
And lastly, amongst key brokerage calls, HSBC has upgraded Info Edge to a buy from reduce and hiked its target price to 1978 rupees from 923 rupees per share. The stock few percentage points away from the target price.
All right. So a few stocks there. We've spoken about Jet Airways and this lifeline. Mint report, Avinash, but considering the pace at which their flights are getting grounded, is that going to be a bit of a dampener? The stock, though, has in fact stopped reacting either way, either on the positive or the negative. So we're really not a bit clueless in terms of the direction the stock could take.
No, I think Devina, clearly, as everyone is aware, the deal for the infusion of funds is very important, and I think until that happens, the stock is not going to go anywhere. As far as the quarterly numbers are concerned, I would believe the Jan to March quarter could be another horrible quarter, considering that many aircrafts have been grounded. Their operating losses have been going up. So I think you could see possibly a bigger loss in this March quarter, and thereafter possibly once the deal happens and the liquidity and the funding happens, possibly one could see some sort of an upward trajectory here. Till that time, I would believe that Jet is not going to go anywhere. It's going to possibly lie where it is. I think markets are awaiting the deal as fast as possible.
Trading calls on two stocks, Gaurav, Bissa, Jet Airways, as well as State Bank of India, which is starting off as the top Nifty 50 gainer today.
As far as the Jet Airways is concerned, the immediate hurdle would be around 245 to 46. If these levels to be sustained, we can expect a decent amount of rally coming in. It can then head towards a level of 257 to 58. Indigo, we saw strong momentum coming in. Jet, for some reason, could not participate. The leftover feeling would now catch up, and I expect if 245 to 46 is held on to, it can go towards the level of 257 to 58. Stop loss of 240, one can buy. For SBI, there's a strong hurdle at levels of 290. I would not play at any rises. I would rather play on dips. At 290, there will be very strong resistance. So for me, it's a buy on dips candidate.
Okay. Avinash, are you putting in some money to work? If so, which company looks attractive for investment purposes right now?
In fact, Neeraj, we have been recommending Deepak Nitrite to our clients. We believe that the kind of capacity expansion the company took mostly on the phenol and acetone facility, that has taken off in November, and the management commentary has been extremely strong. The numbers have also been very strong in the third quarter. So our sense is, this is one mid-cap company which possibly could fit in the bill if somebody is willing to take a 12 to 15 month kind of call. Strong earnings growth and better operating metrics both on the phenol as well as on the basic chemical fronts is going to ensure that you could see a decent upside. In fact, we are looking at a price of at least 330, 340 over the next 12 to 15 months.
I'm just have a follow-up out there very quickly, Avinash, 20 seconds or 30 seconds. EV EBITDA, it's trading at some 16 times. It's not cheap.
No, it's not cheap, but typically the performance-based chemicals, in fact, was a loss-making business for the last 2 to 3 years. That has turned around, and EBITDA margins are in excess of almost 22 to 23%. So I think based on FY19, possibly it looks overpriced, but if you look at FY20 and 21, the top-line visibility is now assured, and our expectation is that possibly top-line, which is currently about 1,800 crores, could possibly double in the next 2 years. So I think the markets are factoring in this factor, when you look at the EV to EBITDA.
Okay. Thanks, Avinash, for joining in. Really appreciate you taking out the time. That's Avinash Gorakshakar there with his views. 1 minute left to go for market opening, so we'll quickly get in those top calls from both our technical experts. Gaurav, Bissa, I want to start off with you for your top call.
It would be better the kind of breakout and data it has seen, the kind of potential it is showing. I would recommend buying Petronet. 240 would be target, 231 would be the stop loss.
Okay. What about you, Brijesh?
I would go long on Godrej Industries around 511, 512, keeping a stop loss of 492 and for the target of around 548 on the upside. Trading could be 2 to 3 days time frame.
Gaurav, what's very quickly, about 1/3% for the bank Nifty. Quick 10-second call. Would you initiate a long here?
If it manages to sustain our levels of 27,800 spot levels, then yes, one can buy, keep a 70-80 point stop loss on the upside. 150 point up cannot be ruled out. That's a swing high that has to be held on. Don't buy on the opening trade, but give it a 15-minute cannot be formed.
Okay. Gaurav as well as Brijesh, thanks so much, gentlemen, for joining me today. Really appreciate your time. Here's how the starting off for our markets this Monday morning, about 1/4% up for the Nifty 50. In a bit, of course, we'll speak to Adrian Mowat as well. But 1/4% for the Nifty 50. The Nifty Bank flattish moves, just about sustaining around the 27,800 mark that our experts recommended. Let's wait and watch if it manages to do that consistently. The mid caps and the small caps, about 0.5% for the mid cap index, small cap index 0.5% too. So it's not a bad start, by the way. The world is a very quiet place, but India started off reasonably okay for itself in the session today. What about individual movers? Let's bring up the heat map. A lot of green, very little red. In fact, only 2 stocks or 3 stocks, and those 2 hardly in the red. So there is an overwhelming sense of green, but by virtue of this market breadth, one would presume that there are not too many big movers. ONGC marginally higher, IOC higher, Eicher Motors higher, no big heavyweights save for State Bank of India, which also is not really the heaviest of weightages, but which is up about 1%. But aside of that, it's just a lot of stocks being in the green or showing a tinge of green right now. Let's see for how long it lasts. I think the oil and gas space is the biggest mover. The PSUs, ONGC and IOC, doing reasonably okay for themselves. Aside of that, no big gainers in early morning trade. So then let me quickly just mark a couple of trend makers and news makers before I hand it over to Devina for what's happening across the broader end of the spectrum. Firstly, CERC relief for the power generators. Not so much of a relief if the stock price is to be believed, or maybe they moved up ahead of the event. NTPC certainly did, but all the stocks are starting off very, very flat in the session today. The 3 names that brokerages have spoken about, very, very flat. What about stocks which were the key movers as of Friday's session, and let's bring those up. Advanced Enzymes starts off another 1.5% higher. Gujarat Gas, after the 6% up move, is up another 6%, another couple of percentage points. Granules, though, lying flattish in the session. Devina, what are you spotting?
We start off with a few newsmakers then, and Dilip Bilkon, we just spoke about it being the lowest bidder in a project of 480 odd crores. The stock's up 4.5%. Jet Airways, though, probably on the back of the Mint report suggesting that they've got a lifeline for about 2,050 crores from Punjab National Bank. That's up about 3 odd percent. Aside from that, you've got HT Media at 45.5, which is up 4.25. Then the likes of Sadbhav Engineering, which is at 232, that's up 4%. IDBI Bank, you've got Infibeam, EIH. These are some of your top gainers within the broader market space. Aside from that, Edelweiss moves up. Avanti Feeds continues to move up, and in the last 7 days now, adding a total of about 25%. Equitas has moved up as well. You've got Petronet LNG, ICICI Pru, IOB gains of anywhere in excess of 1.25% to 1.33%. Glenmark Pharma, McLeod Russell. These are some of the other bigger movers in the broader market space. The market breadth itself looks more promising this morning. 914 stocks advancing versus 273 stocks declining. Losers in trade though, big knock for REC. Stocks down about 5.8%. Divan Housing is down 3%. Arcom's down 2.5%. Just Dial Tech Solutions and NHPC are some of the other names which look weak at open.
Well, let's get in a market conversation going. Veteran emerging market equity market strategist Adrian Mowat with us on the show this morning. Adrian, good morning. Many thanks for taking the time out and speaking to us at Bloomberg Quint.
Good morning.
We're showing some bit of resilience to the world market moves in the last couple of weeks, Adrian. Would you attribute it squarely to the change of sentiment post the cross-border tensions have de-escalated? Or is there something else which makes India do well while the rest of the EM pack isn't quite exactly roaring?
Well, I think today's probably been quite encouraging throughout Asia EM. We've had the Chinese market corrected on Friday. It's up today more than 1.5%. We've had Hong Kong moving higher as well. So it seems to me that sort of India is part of that trend. I think it's probably also helpful that we've got the date of the election announced. So the election will be over with in the next sort of 2 months, which is quite good, I think, for investors rather than sort of waiting for that to occur. But I really see the India move as one that's part of a more resilient EM. And the reason behind that more resilience, I still believe, is that positioning in emerging market equities is still relatively low by the global investor. So when you do see profit taking, it tends to be a lot more modest than perhaps you are seeing in the US market.
Adrian, as somebody who's advised large money managers throughout his career, if as you look at what's happening in India right now in two big events, one is this cross-border stress, which still in bits and pieces stays alive, and the election overhang, if I can call it an overhang, in the next couple of months. What would you tell big money to do in a scenario like this? The reason I asked this to you also is that the belief earlier was that until May or until the election results is out, FIs will not take any bite in India. The last 10 or 11 sessions have shown otherwise.
Yes, so I think there's a number of items to comment on there. The tensions with Pakistan, we have seen these in the past, and generally they haven't been an economic or a market event over the medium term. So I think the international investors have taken on board what's happened. As there hasn't been any escalation, it hasn't been an important factor for them. I think with regards to the election, international investors, if you go back 3 or 4 months, were probably a little bit too complacent about the election, with a very strong belief that the current government would get re-elected with a majority. I think their confidence around that has diminished as you've got the state election results coming out and some of the opinion polls. I think it's also important to highlight all the Indian performance in 2018, which was very strong. It was the right market to be overweight in. That has not been the case this year. So the international investor, the global investor, has been repositioning their emerging market exposure away from India in favor of other emerging markets. But remember, when you look at that portfolio asset allocation, you've also got to look to see if there's net inflows or outflows from emerging market funds. And we are continuing to see some net inflows into emerging market funds. India gets less of that flow, but does still get part of that flow.
The talk around, the trade war tensions, once they start to look like they're going to subside, is that most of the foreign money, which had been sitting on the sidelines with regards to investment into China, is going to move back into China in a big way, which again starts to curtail the prospects of India getting any funds. Is that something that's a likelihood?
Well, remember that the market will speculate on what's going to happen with the trade talks. So the speculation in late 2018 was very negative. The comments, the tweets coming out of the White House were negative. We've had more positive indications, including some comments from Larry Kudlow overnight, which indicates that progress is being made. I think the sell-off and then the recovery around trade fears has pretty much run its course. And for the market to move higher on a trade agreement, we'll need to see that agreement being signed. So I no longer see that as a big driver. To me, the key driver for the Chinese story is going to be the macroeconomic data. The macroeconomic data has been very poor coming out of China. But if you begin to look at what's happening with stimulus, which includes both a monetary stimulus as well as a fiscal stimulus with the tax cuts, it is reasonable to assume that the macro data out of China will be improving as we move into mid-year. And I think that will sustain the rally, because ultimately equities are about profit growth. We had a contraction in private sector profits in 2018. Hopefully we start to see the market speculating on a recovery in that, particularly as they project profit growth through into early 2020.
We've spoken to a few market participants who are big on India, and according to them, the main focus now for the Indian equities shifts to companies that provide high return on capital employed than just volatility of the earnings factor. Now, considering that India is still not a very cheap market, it is still trading at valuations higher than its historical valuations, is a company-specific approach something that most foreign investors now are going to be looking at? And the fact that when you break the market into two parts, which is your larger, more well-known names versus the smaller names, which are now starting to gain traction, is there going to be a big divergence of that?
Yeah, I think that's a really important point. And, when I look at the way the Indian market has traded this year and compare it with other emerging markets, there's a big dispersion in the returns between the top and the bottom performing stocks in the Nifty. So even just looking at the large caps before we even move on to the small caps. So investors are very much stock specific in their views, rather than it being possible to see some clear sector trends. Now, I think that makes sense for a number of reasons. One is that the Indian macroeconomic environment is really more of a steady as you go, whereas in countries like China, which we've already talked about, but I'd also highlight Turkey, Brazil, Mexico, Indonesia, you're more likely to get a bit of a cyclical recovery being built into market expectations, and you get a clearer sector trend in those situations. The other thing to bear in mind is these sort of strange index composition rules, where when you hit the foreign ownership limits, the stocks come out of the indices. Now, what we see with the international investor is they're very happy to hold stocks that have come out of the indices if they are high quality. So definitely this thesis around stock selection and quality seems to continue to be a key factor when trying to invest successfully in the Indian market. Whereas in other markets, just to emphasize the point, it seems to be much more of a cyclical recovery trade that's in place. And in many cases, it's some of the lower quality, some of the lower ROE companies that are performing best year to date, as they have more of a recovery to discount than the high quality names.
Adrian, one final question from my end, really, and that is with regards to what could happen over the next year and a half in India if earnings show glimpses of re-emergence, but not quite. I mean, you refer to the composition of an index that may well play a factor in figuring out in the eventual nifty EPS that comes out. For 4 years, we've waited for the reversal to come. It hasn't quite happened. The hopes are that FY20 could well be the year again, and they could be dashed as well. Do people stay in hope and give these elevated 18, 19 multiples to India, or at some point of time that will reverse?
Yeah, it's a perennial question, really, isn't it? Because the Indian market is typically forecast to give us high teens EPS growth and rarely delivers that. Perhaps it's sort of partly back to the previous question, which is that there are companies in the Indian market delivering consistent high earnings growth. You pay a high valuation for those, but they continue to deliver. And we get the disappointment in the more cyclical names. I don't see anything at a macroeconomic level which justifies such high earnings growth out of the Indian market. You know, if we think about this in terms of nominal GDP, perhaps India delivers around 10% growth. Last year for the exporters, you had the benefit of a significant weakening in the rupee to nearly 74. Perhaps this year the exporters get less of a help and the average exchange rate this year could be higher than it was in 2018. So if I think about the story for exporters and the lack of a clear acceleration in the economy, I remain skeptical about those high EPS numbers, and the vulnerability will be in the lower quality names, which makes one continue to have a relatively expensive high quality portfolio if you're a dedicated Indian manager.
All right, Adrian, thanks so very much for joining us. Really appreciate you joining in this morning with your thoughts. Adrian Mowat there with his views in the market. Well, for the indices, though, it is up and about in a big way. We've crossed the 10,011 mark on the Nifty now, trading handsomely in the green with the 73-odd point bump up. Sensex is up 200 points, and the Bank Nifty contributing in today's session. That's approaching the 28,000 mark in a pretty quick pace. We'll be keeping track of whatever has been happening in the market, but time for a short break. On the other side, we will discuss the government's latest measures to revive stressed assets in the power sector, new tariff regulations, and more with the Power Secretary Ajay Kumar Bhalla. And next, after that, we will speak to Mayank Singhal of PI Industries on business outlook on how will China's shutdown benefit Indian chemical companies and more.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
know the language of each other. वो एक दूसरे की लैंग्वेज समझने में असमर्थ है. It means उनकी भाषा में एक रुकावट आ रही है, उनकी कम्युनिकेशन में एक रुकावट आ रही है. That is known as language barrier.
With IndianOpen. The Union Cabinet last week undertook a slew of measures to revive stressed assets in the power sector. Investments worth over 30,000 crores were cleared for 4 power projects. The Cabinet also approved the new hydro policy, where all hydropower projects will be considered as renewable post this move. Hydropower projects above 25 megawatts can also avail benefits like financial assistance and cheaper credit. Meanwhile, the Central Electricity Regulatory Commission notified tariff regulations for FY20 and 24, keeping returns unchanged for thermal, hydro and transmission projects. Let's discuss all of these developments and more with the Power Secretary Ajay Kumar Bhalla. Mr. Bhalla, thanks very much for taking out the time and joining in. My first question, obviously, with regards to the stressed power assets that are there, within the system, 40,000 megawatts. Some measures have been taken with regards to provide coal linkages for these stressed power generators who don't have PPAs for the long term. So shorter term PPAs, they still have coal linkages. Even if their PPAs get discontinued, before 1 year, they still have an extension. All these factors put together, how incrementally positive is this in your view?
See, consistent efforts are being made to ensure that some of these stressed assets get revived, especially the commissioned ones. And about 11,000 megawatts assets we have already revived through Shakti policy and other measures. These were another short to medium term effort that till the regular PPAs are available, we should provide coal to these plants to sell power even in the short term, provided power is sold in a transparent manner in the exchange or in our portal. So these are the efforts which high level committee recommended, group of ministers considered, and finally cabinet approved it. I expect that this is definitely going to help some of these assets to have a short term revival, and then in the meanwhile growth is taking place above 5%. So they should get regular revival also in due course. This is a major step because coal linkages till now was being provided only for the medium and long term. So in the shorter term, there was no coal availability in the country other than participating in the auction. So this recommendation also increases the quantity for e-auction coal as well as provision for selling power in the short term. And I'm sure you are aware of that we have brought out another bid for 2,500 megawatt on aggregation basis, basically for the stressed plants which have coal linkages but do not have PPAs.
All right. Is this a recommendation where NTPC would likely be the aggregator?
Yeah, that will the Power Finance Corporation is the aggregator, and one of the agencies will be aggregating on their behalf. This bid is already out. So we expect, earlier also we had done this, and 1900 megawatt, and all those people, generators who participated were the stressed plants. And this also I expect in 2500 once the bids are invited. We expect most of the power plants which are stressed, the commissioned capacities which are stressed, will participate in this.
Right. So just one last question. One question on this count, where we are talking about providing coal linkages via Coal India to some of these stress power assets. Is that likely to put additional pressure on Coal India, to the coal supply that it's witnessing? And do you think that it's going to be able to take on this additional burden to supply to these kind of stressed assets?
Coal India has their action plan to increase production, and they have been opening new mines or increasing production of the existing mines. At times there were logistical constraints and all, which also we regularly discuss with the railways, and in some cases even lifting to shorter distances by road has been allowed. So the comprehensive efforts are being made. I expect that Coal India will definitely stand up to this requirement, and whatever additionality is required, they should be able to make available. They have certain surplus production in some mines where rail connectivity issues are there, and it is being worked out. The road strengthening has taken place, so loading has improved. I mean, if you look at the yearly dispatches of coal for thermal sector, there is remarkable improvement as far as coal dispatches are concerned.
The other side of the equation, obviously, when you addressed one angle, which is coal availability, the other angle obviously is the risk, the counterparty risk, given the discoms and the kind of precarious financial health that they currently are in. They're not making payments as such. So with regards to the flow of money coming in from discoms to these generators, how is that angle being looked into?
See, that is right. In the last 4 to 5 months, the outstanding dues by discoms have gone up. Of course, if we look at the national level, it is about a month's dues which are overdue to be paid. But then in some states, this amount is very high comparatively. This has to be looked at on the other side, that the almost equal amount is recoverable from the government departments, which is we are pursuing with the state governments also, that timely payment should be made to the distribution companies so that they are able to discharge their liabilities. We have been trying to address this problem. If I look at last 4 years tariff applications, discoms have been regularly going to for the tariff enhancement. It has taken place over the last 3 years. This year we are finding that either there is no enhancement or very small percentage enhancement is there. So, I mean, if I look at overall losses of the discoms, these have come down, partly because the debt being taken over, but partly because of their operational improvement. The billing efficiency has gone up by 8 to 9% nationally. So there are improvements, but may not be up to the targeted level. Many of the discoms were supposed to reach the 15% AT&C losses by March 31st of 19. And some of them, as per the half-yearly results, are slipping, but generally the second half always gives better results because subsidies and all are released. So we expect things will be looking up for discoms. There could be some delays in payments, but that is being regularly discussed with the state governments and distribution companies.
So, but would you believe this move of power companies being able to terminate the PPAs for the defaulting discoms is a move in the right direction?
See, it's a comfort to a generator in a monopoly situation where he has no choice, and if discom doesn't make payment to him, he has nowhere to go because he loses his linkage immediately if he is terminated. So that is a comfort. I mean, not that everybody is going to exercise this, but at least if a generator feels he can, in the shorter term, looking at the market situation, they can pick up another PPA in the times to come. They may look at this possibility. It's a comfort. I mean, it was basically a discussion with the IPPs that they always projected that we have no choice. I mean, when discoms don't make payments. So that is what sort of one route has been provided to them, whether they can exercise. You can ask definitely the question where are the PPAs available. So they will be cautious in exercising this, but let's see, I mean, whether a market situation changes in a year's time, and once the demand is, which is on the increase, if it crosses 7%, then definitely, I mean, there should not be a problem.
Then, Mr. Bhalla, in light of that, is the payment security mechanization, which has been recommended by the HLEC, a more feasible option where your public financial institutions such as PFC, REC make upfront payments and then collect dues from discoms and charge interest for delay of payments?
Yeah, that simple bill discounting systems is already available as part of the power purchase agreement. But looking at the health of discoms, people, I mean the financial institutions were not discounting this. So there is this thing that the liability comes to a government company. Can we have a tripartite agreements with the support of RBI? Now that needs further discussions with RBI and all, which we are now discussing separately, and looking at whether that backstop arrangements with the support of RBI and the state government joining as tripartite arrangement can be made or not. So that is still under examination.
So Bhalla, have you been enthused by the CERC regulations as well? I mean, one, the fact that they've not cut the regulated ROE, which would have been a move that would have been done under pressure, so to say, because everybody expected them to do that, but and would have provided marginal relief to discoms. But I think what everybody else is saying when this move has been done in the current fashion is that the tightening of operating norms for availability and ramp rates essentially strengthen the discoms and also give leeway to the producers. So it's a win-win situation for both.
Exactly. I mean, see, the effective ROE may look little higher, but if a project takes 4 to 5 years time, the effective ROE comes down, and post 25 years the single part tariff now has been brought in. Earlier, once in a 5-year window, ROE was reduced, but it has been brought back. The government generators have been saying they are able to raise money at this ROE at a much lesser rate of interest. So it finally has lesser impact on the tariff. So regulator has considered all these in a public hearing. He has considered all the options and have decided to retain it. And as you very rightly said, he has brought in certain tightening on the other sides on performance and appraisal norms, and whatever coal-related issues were there on coal as received versus as fired, that also has been answered in this regulation now by fixing a CA determined norm of 85 kilocalories for the storage of coal. So, I mean, and there are various other improvements in this regulation, which we expect should be a very fair thing to the discoms.
Okay.
As you yourself mentioned about the ramp rate, some additional incentive has been also built in.
Yeah, I was just wondering if this move has been also done more as a signaling mechanism. The last 2 or 3 times, whenever this came for revision, there was stress that, okay, let's, there will be a cut. By virtue of this move and balancing it out via the second part that they've done, is there a signal given to both investors and power producers that this ROE move may be here to stay?
Could be. See, it's a process of consultation where both sides make different arguments. Discoms also and state governments have made their arguments as well as generators. So this is what the regulator has decided, and at this ROE at this moment, I mean, as looking at the project construction and all, it's a fair thing to be kept like this. It brings in the interest rates for debt raising and all. So I mean, it's not that high also.
All right. Just one last question, Mr. Bhalla, before we wrap up this discussion also, with regards to the policy shift, with regards to the renewable energy tag given to hydropower projects and the push that this segment has got.
See, hydro sector, we felt over a period of time has the number of projects which were coming up are very few for different reasons. One thing was the upfront tariff was looking very high if we used to determine tariff as per the existing CRC norms. So the project life has been increased to 40 years in this regulation which we just discussed. And on the other hand, we had a detailed discussion with the lenders that can we fine-tune the recovery in a manner that the tariff escalates, it's backloaded, and sufficient, I mean, debt servicing ratio is maintained and sufficient return on equity is available in the initial years also. So that model, once we prepared and discussed with the lenders, it sounded as if it's a win-win model. Discoms are also on board to sign a PPA at a tariff of around 4 rupees, 3 rupees 90 paisa, which escalates at 1.5 to 2%. And the levelized tariff comes at the same level as today's CRC regulation determined levelized tariff. Certain other rationalization in this regulation has been made on the O&M and base calculation for the O&M expenditure, which will again make the tariff reasonable. In the whole hydro sector, one issue was high tariffs initially. So we have tried to address that. Declaring it renewable will definitely ensure better funding for these projects. A cheaper source of funding should be there. And we have providing certain infrastructure support, as most of these projects are supposed to be coming up in remote areas where road infrastructure is not there and you have to carry heavy machinery. And if the flood moderation component is there, it is difficult to recover it from the electricity tariff. So that also has been agreed that will be supported. So all these measures and some more projects in the pipeline, as you rightly mentioned, we have cleared few projects in the recent times. And once the work starts on these projects, we expect this hydro definitely gets a boost. And it's a very, very important power for us to accommodate large chunk of solar and wind energy, intermittent energy, which we are looking at in the years to come.
Okay, Mr. Bhalla, we could go on and on, a bunch of issues, but I appreciate you joining us this morning and giving us some thoughts on the recent moves. Thanks so much for taking the time out and being with us today, sir.
Thank you. Thank you very much.
Well, that's the Power Secretary talking about the recent spate of moves. You know, I know the common referral would be that there's lots more that needs to be done, but frankly, those conversations can go on and on. I think his views on the two recent moves that have happened are fairly encouraging. He's happy with the way the new guidelines have been done as well, and the fact that the ROEs have not been cut, which was probably the more popular belief that would happen. Let's see if it's a good signal to investors. But Devina, I must say that the markets by and large are doing reasonably well for themselves as well this morning.
Yeah, and with gusto, you can see the Nifty way past that 11,100 mark. We've got the Sensex doing well, almost 300 points higher, and just 5 points away for Bank Nifty from the 28,000 mark. So that too is up about 234 odd points in the session.
Yeah, just one quick word here. PSUs are doing really well. So HPBP IOC up and about in the green. Coal India another 2.5%. State Bank of India 2.5%. ONGC about 1.5%. The PSU space is doing remarkably well in the session today. Do watch out. Let's see if the gains continue. The volumes too out here very, very positive. Okay, the next piece on IndianOpen. China's decision to shut several chemical manufacturing units to rein in air pollution and protect the environment may benefit several chemical exporters in India. PI Industries may be one such company too, which the 60% of its revenue comes in from exports and likely to gain from this move. To talk about this in greater detail, joined by Singhal, Managing Director and CEO at PI Industries, and Yash Upadhyay from our research team to take this conversation forward. Yash, over to you.
So let me first start off with asking you about the benefits that most of these companies would get, because over the last couple of years we've seen Indian companies are believed to have benefited from the change in environmental norms in China, pushing up costs there. And as we speak to you today on the back of an extremely strong quarter for the company that saw profits rise by nearly 33% on a year-on-year basis. Is there room for further growth going forward, not just for PI Industries, but for the industry as a whole?
I think if you look at the agrochemical industry, yes, as rightly mentioned, there are the headwinds from China which have created certain challenges for the agrochemical supply chain worldwide. Definitely, Indian industry is well poised to take advantage of the situation. And I do see that at least for the next couple of years, organizations which in the agchem space will be well able to capitalize this opportunity for global exports.
And are these growth levels sustainable going forward? Because we've come across multiple brokerage reports recently pointing out to the fact that China may have relaxed its focus on pollution, potentially resulting in an increase in production there.
Let me answer that in two parts. One, if you look at the China reports which are talking about from a point of saying that the global environmental norms will be relaxed. But let me also point out here that China is, in any case, upgraded the norms in one way or the other. A lot of the plants have been shut. which in return has pushed up costs. It's not that it's going to go back to the old structure, old cost structure. So obviously Indian industry is far ahead and is meeting a lot of the global capabilities and norms. On the other hand, China is a producer of the basic chemicals where the cost structures have pushed, whereas India and some of the key companies in this space are operating the value-added play. So this pressure would come on the basic chemicals, and if Chinese industry were to relax, yes, there would be easier availability that would bring certain costs down, but more so in the basic and commodity products. Now let me talk about Indian and Indian company growth. I think looking at the fears and challenges of China, a lot of global companies and Indian companies have put up basis for manufacturing for growth. So what I would say that we should not look at it a quarter-to-quarter basis, because quarter-to-quarter basis could be based on certain spurts and demands or supplies which need to be made within the quarter. But we must look at it from overall long-term perspective. And if you were to look at it from a long-term perspective, I would say Indian industry is definitely poised for a good growth. And coming to PI, I think we are a very good order book position, and we are confident of delivering a consistent growth over the next 2 to 3 years.
So the exports business for the last 2 quarters has been performing exceedingly well, even beating most of the street estimates. Could you help us understand what are the factors responsible for this, and is this a one-off on account of the low base?
As mentioned earlier, as you would be aware that yes, this is as per in expectation from the projection that we had laid out for the company. Clearly this growth is coming from expansion in capacities backed by a good order book position, and the company is in a steady state to deliver its projects and delivering the growth and the order book that we have. And on a consistent basis, we as projected earlier, we will continue to grow between 18 to 20% over the next 2-3 years.
Right, but so one of the key concerns for the business has to be the margins performance. In FY17, EBITDA margin stood at 24.2%. It came down to 21.5% in FY18, and for the 9 months of FY19, that number is even lower at around 20%. Could you help us understand why has this happened, and what are we doing in order to counter this? Secondly, are you seeing any signs of revival, if not a safer, growth in margins?
Sure, as mentioned earlier, the margins have been under pressure because of certain spurts and rises in terms of the costs of raw materials. And obviously we are in the higher end of the value chain, we are more where we are focusing. And on the other hand, the company has been investing to augment its capacities and to also look at expansion and overheads, which have contributed to this margin. But as we move forward and we get to the stabilization phase, you will see these margins pick up as you've seen in the last quarter.
So could we expect margins to recover above the 22% mark, say over the next couple of quarters?
No, we have already, as we stated earlier, the margins will remain around between 20 to 21% for the year.
Okay, sir. Domestic business, coming forward to the domestic business, erratic rainfall in the key agrarian states.
Yeah, and they'll nudge as we move up with growth.
Right. So coming to your domestic business,
sure.
Erratic rainfall in the key agrarian states as well as poor prices in key crop regions remains one of the biggest concerns for the company. However, the government in successive budget announcements have given a greater focus with initiatives in order to increase the farm income, by increasing the MSP as well. As a result of this, do you expect the domestic business to perform better going forward?
Yes, the domestic business for PI has done well and well within our expectation. I'm sure with the government initiatives, which is on agriculture, there will be more demand for throughput and from the farmer and to get more productivity and yield. And the basis of this, inputs would pick up. Although the ag chem is a very small part of the total value of agri-produce, not over more than 2 to 3%. On the other hand, please do appreciate that the agrochemical business is very dependent on very much on climatical conditions, and agriculture in India unfortunately is dependent on climate and water, and that can be only best answered as to how the weather reacts closer to the season for when the farmer is producing.
And a large chunk of that growth will have to be supported in the form of additional capacities and product innovations. Are there any such plans on the table, and if you can share the details of the same?
Yes, as you know that the company has looked at to embark on a 300 to 400 capex for the next year in order to build up capacities for our demands. On the other hand, we will be launching 3 to 4 new molecules in the CSM export business, and we will be also launching 2 to 3 molecules in our distribution business in India in the next coming year.
Lastly, sir, in an event where India were to replicate some of the measures in terms of the tightening of environmental norms, and as we've seen in the past with some of your peers as well, having been met with a ban on production, how well are you positioned to address this issue?
Well, let me answer that again in two parts. India as a country, I think, is very well in terms of global norms and processes which have been set up by the government for environmental management. And this has not been from now. It has always been in thinking and operation for the last decade. And it's only getting better, which we definitely appreciate. And as a company, we believe in the highest standards of safety and environment, and the company has been very well recognized for that. We believe in creating benchmarks, just not following norms. We believe going beyond the call. And I think that's where I would say, we have been very well validated, evaluated by global standards, by global partners, and have been certified with the highest ratings in that space.
Well, thank you so much, Mr. Singhal. We'll leave it at that. And thank you so much once again for taking the time out and speaking to us. Back to you guys in the studio.
All right, Yash, thanks very much for that. That's the conversation with management at PI Industries. The market's still going strong. It's 90 points on the Nifty, a good 281 points on the Sensex.
Well, looking strong. Broader markets still looking okay. It's a good time to wrap up this leg of Indian Open and hand it over to the FNO show, which will take forward all the queries on the liquid names. From Devina and me and the team that put this show together, thanks so much for watching.